After a poor run in 2022, pharma and healthcare funds are up a humongous 22.4% year to date on average. The fundamental driver behind this rally is the turnaround in the US generic market, says Mr. Chirag Dagli, fund manager, DSP Mutual Fund, in an interview with Business Standard. He explains that price erosion in that market is now getting arrested. Approvals for new drugs are coming through, and supply disruptions in that market are working to the benefit of Indian players. If you are contemplating an investment in a pharma fund, do watch this interview for an in-depth insight into the sector's prospects. Good morning, Mr. Dagli, and welcome to our show.
Good morning. Thank you. Thank you so much for having me, Sanjay.
Pharma funds have been underperforming for some time, but now they seem to be staging a comeback. So we thought this was a good occasion to speak to you and get to know whether this comeback is mainly funds flow driven, momentum driven, or are there some fundamental factors behind it? But we will begin by going back a little and reviewing the performance of these funds in the recent past. Pharma funds performed very well in 2020 and 21. In 2020, they were up a humongous 66.5%. In 2021, again, up 20.5%. What were some of the reasons for this stellar performance of these funds in these years?
So, Sanjay, 2020, 2021, both calendar years were COVID times. We were under very uncertain times. For the rest of the market, there was a lot of uncertainty every day. We were discovering new things. The lockdowns across countries, across within the country as well as in other markets, other countries as well, was very, very different. So it was a different environment. Pharma, healthcare, the environment or the impact of COVID was not as much as the rest of the market, rest of the sectors, and which is why these stocks, these sectors found flavor with the market. Although the business impact per se was not much for the pharma business, but the positive impact was not much, but the negative impact versus the rest of the sector was hardly there. So that was there. That is one important point. However, I also think that I also want to, go back a little bit, before COVID. I think the building blocks of an upcycle for pharma was actually formed somewhere in the late 2018, early 2019, where you saw 4 or 5 years of massive underperformance of the sector driven by the US generic, down cycle, and a lot of companies stopped investing, etc., for that market. So I think the building blocks were already, being formed back in 2019. What COVID did was essentially just crunched the upfronted the returns in 2020 and 2021, which is what what we've seen is that a lot of returns for the last 3 years for the sector as a whole actually came in the first 12 months only.
What were some of the reasons for the recent underperformance in 2022? These funds were down about 10% on an average.
So I think 2022, the rest of the market was very, very good, right? I mean, we've seen a very broad-based rally across the market. And coming specifically to healthcare, I think again, the US generic business went through some challenges. There was very high pricing erosion after a good 2020 and a good early part of 2021 calendar year. We saw a little bit tough, second half of calendar 21 and 2022. So that was one important aspect. The other aspect was also the higher raw material prices that the sector faced, and because of which margins for the sector, which generally were in the ballpark of the 20s kind of range, they actually came down substantially. So that these two were the large reasons why, in 2022, we see the sector underperform margins as well as the US generic.
And the erosion in margin was driven, I suppose, by lockdowns in China, higher prices of APIs. What were the reasons?
Uh, part of it was that, I think overall we saw higher raw material prices, not just from the China bit, but also from, so for a lot of products where we don't import the final product from China, the intermediates still come from China. So yes, part of this was driven by China, and part of this was driven by higher competition in the US generic business.
Now, year to date, these funds are up 15.2% on average. What is driving this comeback?
See, I think the change is the US generic cycle is turning around. Um, we're seeing already prices not contract as much. We saw double-digit kind of price erosion back in 2022. That we are now seeing get arrested to early single-digit kind of number, and that is a very manageable thing. So that's the first change. The second change is that the FDA, which was hitherto not visiting facilities, not doing physical inspections, has now started doing physical inspections, and we've started seeing new approvals come through for our Indian players. As you're aware, new product approvals is the biggest growth driver for the generic industry. So new product approvals have started flowing through. And the third reason is that we are now seeing supply disruptions in the US market. There have been a couple of bankruptcies. There have been some, changes, to the supply chain in the business, and to that extent, we are seeing a lot of supply disruption, because of which the overall, Indians stand to benefit. Indian players, by and large, stand to benefit. So these are the three things that have changed in the recent past, leading to an up move in the US, generic stocks.
Could you explain the price erosion bit in a little more detail? Why was it so much more steep earlier, and why is it getting reduced now?
Sure. So generic business, it grows with new product approvals, and through COVID, we did not have new product approvals because FDA was not giving, they were not physically inspecting facilities, and a lot of our companies were under, some sort of FDA overhang, as far as compliance issues are concerned. So new product approvals were not coming through, because of which growth was in some sense challenged. And there was so then when you don't have new product approvals, you tend to be aggressive on your existing product approvals, which is why you saw double-digit kind of price erosion earlier. That now is, kind of changing, because FDA has now started giving approvals. So what was a double-digit price erosion is now probably in the low single-digit or mid-single-digit kind of price erosion.
We often hear about the US FDA issuing warning letters to Indian companies. That was, I think, a much bigger issue now. How is the situation now?
Look, I think India has the largest number of FDA approved plants outside of the US. So we are big as far as the US market is concerned. And to that extent, I think, you will hear a lot about FDA inspections, etc. And I think that, by and large, our companies have been able to manage these things quite well. I think these are near-term irritants rather than a longer-term trend. India does supply very large volumes to the US, and to that extent, I think our companies adapt to newer standards that the FDA keeps evolving, and those, I think, our companies are also rising up to that challenge.
Could you give us a sense of the opportunities in the US generic market?
So look, I think US, so India has a 50% market share in the oral solids by volume in the US, which is a fairly large market share, which is why I say that India is very large. So our participated market share is close to 50%. And, but the oral solids bit is only half of the overall US generic market. The other half, which is the non-oral solids business, these are products like, ointments, inhalers, injectables, patches, and so on and so forth. In these products, our market share is far smaller. If you see, these are traditionally called, complex generics, as you would have heard this term come up a lot when you hear companies talk about their US business. When you see the opportunity here, a lot of investment over the last 5 years has gone in this bucket, right? And I think as we move into the future, we will see a lot of these new product approvals come through in this bucket, which is the non-oral solids, and India will continue to gain market share even in the non-oral solids bit. Now, and this is no longer just this is no longer just hope, right? We are already seeing a couple of Indian companies get product approvals for complex respiratory products. We've seen Indian companies get approval for complex injectable products, etc. So the proof is already there. We are just going to keep scaling up on this aspect.
And how strong are Indian companies on the R&D part?
Oh, significantly. I think one of the big things about Indian companies is that, and let me just give you some numbers here. The largest Indian company in the US generic market will be a quarter of the larger US generic peers, right? So there's a Teva at $3.5-4 billion in the US, and most of our larger companies in the US will probably be a billion, 1.2. So we are much smaller. That said, our R&D effort, most of our companies spend upwards of most of the larger companies, I would say, of that scale, spend upwards of $200 million in R&D, and that compares to probably a $400 to $500 million that a Teva spends. So the larger companies are actually 4 times India's size, but their R&D budgets are just 2 times. So that tells you how significantly invested Indian companies are in the generic R&D space for the US.
But do Indian companies feature anywhere when it comes to new molecules?
Not in NC. We are talking about the generic business. We are not talking about new chemical entity business. See, the new chemical entity game is very, very different. And we are seeing a couple of Indian companies actually rise up. But this is I think NC, the new chemical entity research game, is either a big boys game or a small startup game, right? There's nothing in between. And I think we're some time away in that. There are early signs of our companies starting to do new chemical entity research, but we haven't seen any organic success from the Indian companies as far as new chemical entity research is concerned.
Overall, what is your
Sorry, I missed that question, Sanjay.
Yeah.
Can you repeat? Sorry.
Overall, what is your assessment of the US generic market? Are things looking up for Indian companies or?
No, definitely things are looking up for Indian companies. I think, see, the changes that are happening in the US business, I think India will stand to benefit because it remains the only country that continues to invest in the US generic business. So we see India as a big beneficiary of whatever is happening in the US generic business.
Let us turn to the domestic market now. What are the opportunities in the domestic market?
See, I think domestic is the happy story for the India pharma piece. This is a business which has historically grown between 10 and 11%. There were a couple of pops through COVID in the second wave, when we had treatments available for COVID, when the growth actually inched up, and then it is now back to the back to the double digit, early double digit kind of growth. Now this is here to stay, and this market, we still see a lot of opportunity. If you broadly think about how this 10% estimate is kind of broadly broken into, what you see is a 4-5% kind of price increase, price and mix improvement, and about 2 to 3% kind of new product introduction, and 2 to 3% of core volume growth in the older molecules. So that's how it's a evenly balanced growth between volume, new product led, and price and mix led growth. That prognosis kind of continues, and I think most of our companies are talking about double digit growth, early double digit growth in the India business, and it goes through its it's far less cyclical. There will be times when acute grows faster, there will be times when chronic grows faster. By and large, if you look at the business for most of our companies, this is how we're thinking about that it is a double digit, early double digit growth kind of a business. One interesting thing that has happened in the India business is that a lot of our companies which were till at least 2 years back not investing or not expanding field force meaningfully, over the last couple of years have, especially after the after COVID kind of normalized, people have just added field force, trying to tap into newer markets, newer geographies, reach, improving their doctor reach. So a lot of that effect, the impact of all of that we'll now see. Last 2 years, companies spent on training these medical rep field force, and this has had some impact on margins. As we get into the future, over the next 2 years, we see improvement both in margins for the India business, driven by medical field force productivity improvement, and the usual growth that the business is expected to see.
Could you explain for our viewers' benefit what is NLEP, the National List of Essential Medicines, and how does it impact pharma companies in their domestic business?
Understood. So, I think about roughly 20% of the India pharma market by value is in the NLEM products. NLEM is the list of, like you said, the essential medicines. What happens here is that these are price controlled products. These are products where the price increase that you take is actually limited to the to inflation, WPI linked inflation. So NLEM has been in the past, when there was a cost based kind of an price control, people used to avoid getting into newer competition would not come into NLEM products. That still is true a little bit, but what happens is that today the pricing is actually controlled in the sense that you give only WPI linked price increases. So that's that's NLEM list. So the government will come up with an NLEM list, and then they will look at prices of all the players for those molecules, and take the average of that as the going price, and everybody who's above that average will have to come down to that average price, is how this broadly kind of works. This exercise happens once every the list of NLEM comes up every 5 years, and the exercise of pricing it happens every year. So that's how this works. And like I said, roughly 20% of the industry, give or take, is in the NLEM list. Versus the past, I think NLEM today is far more predictable and far more manageable for our Indian companies, because the policy is very stable, policy is very standard. So it is, in the past there used to be a lot of disruption and havoc used to be created on these price controls, etc. That is no longer true by and large for the industry. Sure, for a couple of players here and there can be, that can be true, but by and large for the industry, NLEM has become far more manageable, far more predictable versus the past.
Besides pharma companies, which are some of the other segments of the healthcare sector that you are positive on? Are you positive on hospitals and pharma or pathology chains, etc.?
So I think, see, hospitals as a business we like. It is a very strong moat business. Once you put up a hospital in a location and it starts doing well, there's a massive entry barrier for a new hospital to come up within that location. So we like this business, but I think valuations today versus the past are a little bit punchy. And to that extent, while we like the business, we're not very comfortable with valuations for some of the hospitals. So that's one. As far as pathology is concerned, I think pathology as a business is something that has seen in the past, growth come down, especially for the non-COVID business. What used to be a double digit, 13-14% kind of growth has now come down to about 9-10% kind of growth. And we think that most of this is, basically volume driven growth. So this industry has seen more competition, has seen volume growth come off a bit. And we are a little bit concerned about valuations continuing to be punchy, especially in context with the poor growth that the market is overall seeing. So pathology still remains a business where I think I have concerns about increasing competition. Our method there is that we want to buy businesses which are radiology and pathology put together, right? Radiology is a far less disruptable business. You can't order a MRI scan sitting at home, right? I mean, you have to go to the lab to get a MRI or a CT scan done. So we think it is a far less disruptable business, and we think that a hybrid model will probably be better rather than a standalone pathology business.
Now, the long-term returns of pharma funds, say if we look at 10-year returns, they are in the double digit. So that does make a strong case for investing in these funds. At the same time, these are sector funds which are likely to go through strong, high degree of volatility. What would your advice be to an investor who is looking to invest in these funds currently?
You make a very valid point, Sanjay. These are sectoral, exposures. Healthcare within that thematic or sectoral fund, healthcare is a small fragmented sector. The 70 stock BSE healthcare index has a profit equal to one, profit pool that is today equal to one company TCS, and the market capitalization is equal to one company HDFC Bank. So small fragmented sector, and these multiple businesses, pharma, India pharma, exports, pathology, hospitals, medical equipment, and so API, CDMO, multiple businesses within this 70 names. This is a small fragmented sector, very diverse and different drivers for each of these businesses. So what we are essentially saying is that by virtue of owning a large cap diversified equity fund, you probably have 4 or 5% weight in the healthcare sector, not more. You probably want to top it up with an active, healthcare scheme. You want to top that up with an active healthcare scheme, because this is a sector where wealth has been created in the past, and across the globe, if you see, these are this is a sector where wealth has been created, whether it is developed world in the US or Japan. Even those markets, healthcare as a sector is still in those mature markets, even healthcare as a sector is still growing. So we have a long runway to grow. Plus we have the export bit as well. So what we are saying is that you top up whatever, let's say, whatever your number in your mind is, let's say hypothetically 8-9% is your healthcare exposure that you want to have. You probably own already 4-5% in the sector. So whatever that number minus 4-5 is what you need to own as part of a healthcare active healthcare scheme, is what we are essentially saying. The other bit is that the reason why I am advocating a active healthcare fund is that it's a diversified exposure and not exposed to one theme, whether it is US generic or India pharma. There are multiple themes within the sector to play. When you own a active healthcare fund, you are actually having adequate exposure to all of those themes. This also reduces the FDA related risk. See, the FDA related risk is there, right? Even high quality companies, very good companies with very strong compliance standards have gone through bad FDA inspections. It's not a Six Sigma event, 1 in a million chance that FDA will go, a company will go through a bad FDA inspection. That's not the case. There's a fair amount of chance that a good company also goes through a bad FDA inspection. And that comes with its own commensurate volatility in the stock price. How do you manage that risk? There's only one way. It is an unknown. There's only one way to manage that risk, which is to diversify it through a portfolio. That's how we are kind of thinking about this. And that would be my advice to investors. That you decide what your allocation to healthcare should be, depending on your lifestyle, your needs, your future needs, and then X that out with what you already own.
Thank you, Mr. Dagli. You have made a strong case for investing in healthcare and pharma sector, of course, with due attention to asset allocation. And you have also provided our viewers with a good sense of the outlook for this sector. I'm sure our viewers will gain immensely from this interaction. Thank you so much and have a nice day.
Thank you. Bye-bye. Good day.
Bye-bye.